2022. The dollar is at its strongest point in 20 years. Wall Street is having a great time, and somewhere in Ankara, a family's entire life savings just lost 40% of its value. Not because they made a bad investment, not because they took on reckless debt, not because they did a single thing wrong, but because the dollar got strong, and that was enough. Now here's the thing that's been sitting in the back of my head. If a strong dollar is supposed to be good news, why does it keep quietly destroying people who had nothing to do with America? Because the real answer, the one nobody really leads with, is that that's not a side effect. That's the feature. The strong dollar is working exactly as designed, and the design is about 80 years old. And once you actually understand how it works, you're going to look at financial news a little differently, and you're going to look at the people explaining it to you a lot differently. Okay, so what actually makes a currency strong in the first place? Because I feel like most explanations skip this and assume you already know, which is a bold assumption. Every currency on Earth is competing in this constant invisible auction, right? Every second of every day, people and institutions and central banks are deciding which currencies they want to hold, which ones they want to convert, which ones feel like a reliable store of value, and which ones feel like something you should probably unload before Monday. When more people want dollars, the price of a dollar goes up, and we call that strength. When fewer people want it, it falls. Simple so far. Almost suspiciously simple. Here's where it stops being simple. About 88% of all international trade transactions on Earth, between countries, between companies, between people in completely different parts of the world, happen in US dollars, not euros, not yuan, not some neutral currency that represents nobody's home team advantage. Dollars. A Vietnamese company doing a deal with a South Korean company will often settle that transaction in American dollars, a currency from a country that isn't even part of the conversation, didn't manufacture the product, and wasn't consulted at any point in the negotiation. You want to know how that happened? Good, we're going to get there, but first I need to explain the dial. There's this common assumption that the strength of the dollar is just some natural market force, supply and demand, invisible hand, the economy doing its invisible thing, and that's partially true, but there's also a literal person in a literal room making decisions that move it, and that person is Jerome Powell, and the room is at the Federal Reserve, and the lever is called the federal funds rate. When the Fed raises interest rates, what happens is that American assets, US Treasury bonds, savings accounts, all of that, suddenly start paying better returns than they were before, and global investors notice this, because noticing better returns is approximately the entire point of being a global investor. So capital starts flowing into US dollar-denominated assets, more people are buying dollars to access those assets, and the dollar gets stronger. It's almost mechanical. Raise the rate, currency goes up, and at this point, you're probably thinking, okay, Fed raises rates, dollar gets stronger, Americans win, good news for the home team. Simple. Here's what nobody really tells you. A strong dollar is one of the most efficiently distributed economic stressors on Earth, and America is genuinely the last country to feel it. Most developing countries borrow money in US dollars, not in pesos, not in rupees, not in whatever their local currency happens to be, dollars. Because the international lending system, the IMF, the World Bank, sovereign bond markets, they trust dollars, and they are significantly less enthusiastic about being repaid in currencies that might not hold their value over a 20-year repayment window. So imagine you're a country. You borrowed $15 billion when the exchange rate was manageable. You're paying it back over 2 decades. Standard sovereign debt arrangement. Nothing unusual. Then the Fed raises rates, the dollar surges, and suddenly your local currency buys fewer dollars than it used to, not because your economy collapsed, not because you made different decisions, just because a committee in Washington decided American inflation needed to come down. Your debt just got 40% more expensive to repay. Same loan, same terms, same everything, except a worse exchange rate for you. And you have to come up with that difference somehow, which usually means cutting public spending, or going back to the IMF for a new loan to service the existing loan, or watching your currency collapse as everyone tries to exit it before it falls further. Sri Lanka, 2022. Dollar surges, the rupee collapses, and within months, there's no fuel, no medicine importable at a price the country can afford, and the president's residence gets stormed by people who are, not unreasonably, upset about this situation. One country's interest rate decision, another country's government in free fall, and this isn't some freak accident, it's a pattern. Argentina, Pakistan, Ghana, Egypt, Turkey, the list of countries that have been through some version of Fed tightens, dollar surges, local currency collapses, IMF bailout is long enough that at some point, calling it a coincidence starts to feel like an active choice. But here's where most people arrive at the wrong conclusion, and I need you to stay with me for a second. July 1944. World War II isn't over yet, but it's close enough that 44 countries send delegates to Bretton Woods, New Hampshire, a hotel in the mountains, to answer what is maybe the most consequential question in modern economic history. Whose currency runs the post-war world? The answer was, honestly, not that complicated given the circumstances. The US came out of World War II with roughly half the world's gold reserves and the only major industrial infrastructure that hadn't been bombed into rubble. Britain was exhausted and essentially broke. France had been occupied. Germany and Japan were not in any position to be negotiating global monetary architecture. The US had leverage in a way that no single country had ever really had leverage before, and they used it. The deal: the dollar gets pegged to gold at $35 an ounce, every other major currency gets pegged to the dollar, and the whole international monetary system runs on American money. Any country that wants to participate in the global economy needs dollars, and to get dollars, you need to trade with, borrow from, or maintain a functional relationship with the United States. France's finance minister at the time called this the exorbitant privilege, which is genuinely one of the most precise descriptions of a geopolitical arrangement I've ever come across. What it means in practice: America can run trade deficits that would trigger a currency crisis in any other country, because there's always global demand for dollars absorbing the excess. America can borrow at lower interest rates than its actual economic situation might otherwise justify, because US treasuries are the world's default safe asset. America can print money and export some of the resulting inflation globally, because dollars circulate everywhere, and everyone is absorbing them whether they plan to or not. It's a remarkable position to be in. Now at this point, most people arrive at, okay, so America engineered this whole thing, America deliberately constructed a system to extract value from the rest of the world, that's the scam, that's the villain, found it. That's actually the wrong conclusion, and the truth is more uncomfortable than that. The real situation, the one that I find genuinely unsettling when I sit with it, is that everyone agreed to it, and now nobody can really leave. Countries have been announcing de-dollarization for decades. China, Russia, the BRICS nations have all had press conferences and summits and formal policy announcements about reducing dollar dependence and building alternative payment systems. Some of them have been making those announcements for 30 years, which at a certain point feels less like a plan and more like a recurring agenda item that never quite makes it to implementation. The reason is oil, specifically a deal made in the 1970s where the Nixon administration negotiated with Saudi Arabia, the world's swing oil producer at the time, that oil would be priced and sold globally in US dollars, and in exchange, America would provide Saudi Arabia with military guarantees and security cooperation. That deal, what eventually got called the Petrodollar system, means that any country that needs to import energy, which is every country, because energy is not optional, needs to maintain a reserve of US dollars before it can even keep its power grid running. The invoice is in dollars. The transaction settles in dollars. You can't buy a tanker of crude in yuan or rupees, at least not through the standard global oil market, which means the demand for dollars is structurally embedded in the global energy system, which is structurally embedded in basically every other system that matters, and opting out isn't really a coherent option for most countries. It's more like deciding not to use the internet. You can make that choice. You just end up very isolated, very quickly, and the countries most exposed to dollar volatility are exactly the ones with the least influence over dollar policy, which is a situation that has persisted, basically unchanged, since 1944. The dollar isn't strong because America is powerful. America is powerful because the dollar is strong. It's a loop, and the loop has been feeding itself for 80 years. Think about that for a second. Now, here's the part I find genuinely interesting, and it's the part that almost never makes it into the strong dollar coverage. A strong dollar isn't even unambiguously good news for America. When the dollar is strong, American products are expensive for foreign buyers. American agricultural exports, American manufactured goods, American cars, all of that just became relatively more expensive than competitors who are pricing in currencies that haven't strengthened at the same rate. German engineering, Japanese technology, products manufactured in countries whose currencies just weakened, all of that got relatively cheaper from the perspective of an international buyer converting from their local currency. So American exporters lose contracts. American manufacturers compete harder for international sales, and the places that feel this first aren't financial centers. It's factory towns in Ohio and Michigan and the industrial Midwest, places where an export order matters, where the lost contract means reduced hours or a layoff or a plant running at 60% capacity, while the financial sector in New York is celebrating a strong dollar. Wall Street is looking at a number going green. A machinist in Youngstown is looking at a different number entirely. So who actually wins when the dollar gets strong? Banks, asset managers, the financial sector, the people whose entire job is moving capital around, not the people who make things and need to sell them. A strong dollar is genuinely excellent news if your balance sheet is denominated in dollars and your competitors are paying in currencies that just weakened. It's complicated news if your business involves manufacturing something that that you then have to sell in international markets. And the Fed, here's the part worth sitting with. The Fed's mandate is domestic. They're managing American inflation and American employment conditions. What that does to Turkey's debt servicing costs, or Pakistan's import bill, or the Sri Lankan rupee is genuinely not part of their formal mandate. They're not being malicious. They're just running the dial they were given, which happens to also be the dial for everyone else's economic conditions. And nobody really designed it to work that way. It just kind of ended up that way, and the people with the power to change it are the ones benefiting most from leaving it alone. That family in Ankara I mentioned at the beginning, they didn't make a bad call. They weren't reckless. They were doing the perfectly ordinary and sensible thing of holding their savings in what they had. And then a committee 8,000 miles away decided American inflation was running too hot, and the system built in that New Hampshire hotel in 1944 ran exactly as it was designed to. Is that a scam? Technically, no. Nobody lied. Nobody broke a rule. The rules just happened to have been written at a specific moment in history when one country had overwhelming leverage, and they've never meaningfully needed to be rewritten because the country that would have to rewrite them is the one benefiting most from keeping them the way they are. The best systems don't need to cheat. They just need everyone to keep playing. And the dollar system has made itself so structurally embedded in trade, in debt, in energy markets, in the basic plumbing of global finance that opting out isn't really a coherent option for most of the world. It's more like opting out of gravity. You can announce it. The consequences don't really care. The dollar is strong. On financial news, that's a ticker going green and someone in a good suit saying, "Great news for consumers." In the countries absorbing the spillover, it's a different conversation. And in the factory towns where a strong dollar just made American exports less competitive, it's a conversation that doesn't come up much on the channels celebrating the number. The rules of the game were written by the people who were already winning, and the game has been running long enough that most people forgot there was ever a question about the rules. That's the strong dollar.